Welcome to our financial management course. Today, we will be talking about fixed income securities. Specifically, we will review certificates of deposit, U.S. Treasury securities, agency bonds, municipal bonds, corporate bonds, mortgage-backed securities, asset-backed securities, convertible bonds, money market funds, and preferred stocks. Let's begin. Fixed income securities are financial instruments that provide investors with regular, fixed interest payments and the return of principal at maturity. They play a critical role in both individual and institutional portfolios by offering predictable income, diversification, and lower risk compared to equities. Examples include government bonds, corporate bonds, mortgage-backed securities, and preferred stocks. A certificate of deposit is a time deposit issued by banks, offering a fixed interest rate for a specific term. Funds are locked in until maturity, and early withdrawals usually incur penalties. Certificates of deposit are insured by the FDIC up to $250,000 per depositor per bank, making them a very low-risk investment option. The U.S. government issues Treasury securities to finance its debt. These are considered the safest investments because they are backed by the full faith and credit of the U.S. government. There are several kinds of U.S. Treasury securities. Treasury bills, T-bills, are short-term securities, maturities under 1 year, sold at a discount and redeemed at face value. For example, a 6-month T-bill yielding 5.1% in 2024. Treasury notes, T-notes, are medium-term bonds, 10 years, with semi-annual interest payments. For example, 10-year T-note paying 4.2% annually. Treasury bonds, T-bonds, are long-term debt, 10 to 30 years, with fixed coupons. For example, 30-year T-bond issued at 4.6% yield. TIPS, Treasury inflation-protected securities, are bonds whose principal adjusts with inflation. For example, a 10-year TIPS yielding 2% above inflation, CPI. Next in our list of fixed income securities are the agency bonds. Agency bonds are issued by U.S. government-sponsored enterprises or federal agencies to fund specific sectors such as housing, education, or agriculture. Agency bonds generally offer slightly higher yields than Treasury securities because they are not always explicitly guaranteed by the U.S. government. There are several popular agency bonds. Fannie Mae and Freddie Mac fund residential mortgages. Federal Home Loan Bank provides funding for home loans. Tennessee Valley Authority issues bonds to fund infrastructure projects. Next in our list of fixed income securities are the municipal bonds. Municipal bonds, Munis, are issued by state and local governments to fund public projects such as schools, roads, and utilities. Interest income is often exempt from federal and sometimes state income taxes. There are two major kinds of municipal bonds. General obligation bonds, backed by the issuing government's taxing power. For example, New York City issues general obligation bonds to fund infrastructure. Revenue bonds, repaid from revenues generated by specific projects. For example, a toll road or airport bond repaid from user fees. Next in our list of fixed income securities are the corporate bonds. Corporate bonds are issued by companies to finance expansion, acquisitions, or debt refinancing. They typically pay higher yields than government bonds due to greater credit risk. There are two major categories of corporate bonds. Investment-grade bonds, issued by financially strong firms, rated BBB- or higher by S&P. Junk bonds, high-yield bonds, issued by riskier companies, rated below BBB-. Next in our list of fixed income securities are the mortgage-backed securities. Mortgage-backed securities are created by pooling together home loans and selling shares of the pool to investors. Homeowners' mortgage payments flow through to investors. Mortgage-backed securities played a major role in the 2008 financial crisis due to risky subprime lending practices. there are two major types of mortgage-backed securities. Pass-throughs. Investors receive monthly payments from a pool of mortgages. Collateralized mortgage obligations. Divide mortgage pools into tranches with varying maturities and risk levels. Next in our list of fixed income securities are the asset-backed securities. Asset-backed securities are similar to mortgage-backed securities, but are backed by non-mortgage assets, such as auto loans, credit card debt, or student loans. Asset-backed securities offer higher yields than government bonds, but depend on the performance of underlying assets. For example, Ford issues asset-backed securities backed by car loans through Ford Credit. Sallie Mae issues ABS backed by student loans. Convertible bonds are hybrid securities that can be converted into a fixed number of shares of the issuing company's stock. They offer lower yields than regular bonds but potential equity upside. Convertible bonds appeal to investors seeking both income and potential capital appreciation. For example, Tesla issued convertible bonds in 2017 that allowed investors to convert them into Tesla stock if the share price rose above a set threshold. Money market funds invest in short-term, high-quality debt securities such as T-bills, commercial paper, and repurchase agreements. They aim to preserve capital and provide liquidity. Money market funds maintain a stable net asset value of $1 per share, though extreme market stress can cause deviations, breaking the buck. For example, Fidelity Government Money Market Fund invests in Treasury and agency securities. These funds are popular cash management tools for individuals and institutions. Final one in our list of fixed income securities are the preferred stocks. Preferred stocks are hybrid securities that combine features of both equity and debt. They pay fixed dividends and have priority over common stock in dividend payments and liquidation. Preferred stocks trade on exchanges and can be callable or convertible, depending on their structure. For example, Bank of America issues preferred shares with a fixed 6% annual dividend. These are popular among income-focused investors. This concludes our discussion about fixed income securities. See you at the next lecture.